Hi, this is Chartered Training Center. Today we are going to look at a question on IAS 12 income taxes. Alright, so we are taking the question from ICA past question April 2022. So we are going to solve the question on our screens. So I'm going to read the question and then we'll solve it together. I read Big Green Limited. Big Green is an agro processing company which reports under International Financial Reporting Standards (IFRS) and prepares its financial statements up to 31st December each year. The company intends to comply fully with IAS 12 income taxes by introducing deferred tax in its financial statements. On 1st January 2020, the company acquired an item of plant which costs 750,000 Ghana cedis and has a useful life of 5 years with no residual value. Big Green enjoys capital allowance at the rate of 30%. Revenue generated by using the plant is taxable. Any gain on disposal of the machine will be taxable, and any loss on disposal will be deductible for tax purposes. Big Green estimates current tax provision for the year to 31st December 2020 at 10,125 Ghana cedis. The tax rate of Big Green is 25%. Required: I. In accordance with IAS 12 income taxes, explain the amount to be reported in the Statement of Financial Position and Statement of Profit or Loss for the year ended 31st December 2020. II. Explain the term temporal difference and state one circumstance in which temporal difference may arise. Alright, so this is a company called Big Green and they report under IFRS and now they want to comply with the provisions of IAS 12 income taxes. Alright, and they are faced with this accounting problem and we are supposed to uh, use IAS 12 to solve this accounting problem that they are facing. Alright, so they have an asset, okay, and the cost of the asset is 750,000. Okay, so this is the cost of the asset, and the asset has a useful life of 5 years. Okay, has a useful life of 5 years, and also in terms of capital allowance or for tax purposes, the asset enjoys capital allowance of 30%. Alright, and any gain on disposal of the asset will be taxable, and any loss on disposal of the asset will be deductible for tax purposes. Alright, and the current tax provision for the year is 10,000 and the tax rate is 25,000. Alright, so we need to determine the income tax expense for the year based on the question that's based on the information we have been given. So let's see how we are going to solve this question. Alright, so first of all we need to determine the temporal difference. Okay. The temporal difference occurs when the carrying amount of an asset is more than the tax base. Okay, so occurs when the carrying amount of an asset is more than the tax tax base. So let's find the carrying amount of the asset. After that, we find the tax base of the asset. So let's calculate the carrying amount of the asset. Okay, so we know that the carrying amount of an asset is equal to the cost of the asset, and is any accumulated depreciation, minus accumulated depreciation. Alright, so we from the question, the cost of the asset is how much? 750,000. So that's the cost of the asset. The cost of the asset is 750,000. So now let's calculate the depreciation. So to calculate the depreciation, you need to know the useful life. Okay. So what's the useful life of the asset? We are told that the useful life of the asset is 5 years. Okay. So the useful life of the asset is 5 years. So that means depreciation charge for the year is going to be 750 over 5. Okay, and that will give us how much? 750,000 over 5. That will give us 150,000. 150,000. So that's the depreciation charge for the year. So that's the depreciation charge for the year. So let's calculate the carrying amount. So we know that the cost is equal to 750,000. Then the depreciation is equal to 150,000. So the carrying amount of the asset is going to be how much? So 750,000 minus 150,000 will give us 600,000. So 600,000. So this is the carrying amount of the assets. Okay, now let's calculate the tax base of the assets. Okay, let's look at the tax base. Okay, so the tax base is also equal to the cost minus the capital allowance granted. Okay, so the cost of the assets from our question is 750,000, and our capital allowance, we're told capital allowance is 30%. Okay, capital allowance is 30%. Alright, so it will be 30% of 750,000. So this multiplied by 30% will give us 225,000.